Ladies and gentlemen, if you think today's headline is just silver touched a new high, if you think this is another shiny run-up that fades the moment the Fed speaks or a ceasefire hits the ticker, you're staring at the smoke while the house is already on fire. Because what I'm about to lay out isn't a cute chart pattern or a feel-good forecast. It's a chain reaction. It's the kind of setup that starts quietly in vault reports and procurement contracts, then suddenly shows up as factory delays, busted delivery promises, and a price that doesn't ask your permission. Here's the uncomfortable truth. By the time mainstream financial media treats this like an emergency, the positioning window is usually gone. These situations whisper first, then they roar. The story you're hearing is that silver is strong, targets are rising, and some big institutions see a major price level coming by spring. Fine. But the real story is why spring matters at all, and why the market could shift from tight to unhinged faster than most can process. This isn't just about investors. It's about industrial users, supply chains, and a strategic material that modern civilization quietly burns through every day like oxygen. Think about it. When something is essential, hard to substitute, and suddenly hard to source, do prices gently drift higher, or do they snap? To understand what's happening, stop thinking of silver as a trade. Think of it like a bottleneck. A bottleneck doesn't have to be huge to cause chaos. It just has to be narrow enough that demand can flow through. Silver is used everywhere, but in tiny amounts per product. People underestimate the risk. A smear in solar paste, a thin contact in electronics, a component you can't skip because it carries current reliably. Across billions of devices, millions of vehicles, entire power grids, these little uses add up. What looks small becomes structural. One dangerous myth is that if price goes up, supply will magically appear. Sometimes yes, but that depends on time, permits, capex, skilled labor, refining capacity, and political stability. In other words, it depends on a world that behaves, and the world is not behaving. Here's the setup. For years, the global silver market has leaned on a simple trick. Pull metal from above-ground inventories to cover shortages when mine supply and recycling can keep up. That works until inventories are drained. Once the buffer is gone, every small shock becomes a big shock. That's why vault numbers matter. They tell you how much pain the system can absorb before something breaks. And if you've been watching, those numbers are moving in a direction that should make any serious industrial buyer nervous. Meanwhile, the narrative often fed is that silver reserves are fine, delivery mechanisms will handle it, or there's always metal somewhere. That kind of talk is what people say right before the market discovers the difference between paper availability and physical availability, because paper can be created infinitely, physical cannot. Now, let's talk about the United States. Strategic planning once meant stockpiles, not spreadsheets, not accounting. Leaders understood that if global trade gets messy, factories and defense systems can't run on good intentions. They run on inputs. Stockpiles were insurance. Then complacency hit. The world felt stable. Old threats seemed distant. People sold the insurance to improve the budget. That decision feels painless when prices are low and supply flows efficient. But it becomes a nightmare when conditions change. Because when you liquidate strategic metal in a low-price era, you don't just sell metal, you sell options, resilience, and time. Time is the one thing you can't buy back during a shortage. Today, the United States is far more dependent on external flows than most realize, and dependence isn't automatically a problem until someone else controls the spigot. Refining, processing, and export pathways are concentrated. The country controlling them gains leverage. They don't need dramatic bans. Friction, licensing, domestic prioritization. Any tweak creates large ripple effects in a tight market. Recycling, substitutes, and technology improvements are real forces, but slow ones. In a fast-moving supply squeeze, slow solutions don't save you. Recycling takes collection time. Substitution requires redesign, testing, certification, and retooling. For many applications, substitutes don't perform the same way. When industrial buyers sense a thinning pipeline, they lock in supply, and that's when the market changes character. In a normal market, buyers order what they need. In a fear market, they order what they might need. That might accelerates shortages. This is why spring matters not magic, but timing. Procurement cycles collide with visibility. Contracts get negotiated, production schedules finalized. If a company cannot secure silver at predictable terms, it must choose between paying up, slowing output, or risking a shutdown. No major manufacturer gambles with a multi-billion-dollar operation. They will pay. They will overpay. A crucial point, even big silver price jumps, Don, always make a huge dent in final product costs. Manufacturers can tolerate higher prices before demand collapses. The demand destruction threshold is higher than most assume, so price may need to rise a lot before demand reacts. When institutions float a spring price target, don't treat it as a promise or fantasy. Treat it as a signal. The math inside professional models is leaning one way. The neat target assumes an orderly process. No shocks. Delivery systems trusted, buyers calm. Markets love to break orderly assumptions at the worst moment. Next, exchanges and deliverable inventories. There is a difference between metal in storage and metal available for delivery. Available metal is allocated, warrantable, ready to move. In tight periods, that category shrinks fast. Paper markets may quote a price, but settlement becomes constrained. Premiums detach, spreads widen, delivery delays extend, smaller buyers get squeezed. Price becomes the start of negotiation, not the end. Big picture, silver is not just an investment story. It's an infrastructure story, a security story, a supply chain story. Price can become violent because the world lacks an easy substitute or a quick supply boost. Price has to ration. Constraints disappear only when new supply arrives or demand collapses, and the odds of either are low. You don't need to believe every rumor or projection. You just need to understand the math of tightness. When procurement managers panic, they don't tweet, they buy. By the time you see it, the buying is done. Strategic reserves aren't decoration, they're shock absorbers, keeping industrial bases running when the world stops cooperating. The US used to understand this. Silver wasn't about timing the market, it was about never being hostage to it. High conductivity, reliability, corrosion resistance, tiny components preventing massive failures in defense systems, satellites, secure communications, power grids. Over decades, reserves provided insurance. Complacency, budget pressures, and assumptions about trade eroded that insurance. Strategic positions collapsed, about 73% down from historical peaks. That's not poetic, it's capacity. The difference between absorbing disruption and paying whatever the market demands. Price alone is meaningless if buyers can't source scale. Availability is the reference point. When reserves shrink and dependence grows, competition intensifies exactly when everyone else is nervous. Industrial buyers don't act like retail. They act because production schedules demand it. Fear drives hoarding, not greed. Layer in global deficits. Years of demand exceeding supply drain above ground metal. Once the cushion is gone, small shocks amplify. Global supply-demand numbers show demand running above mine output and recycling, about 1.2 billion ounces versus roughly 1 billion supply, leaving a gap over 200 million ounces. The number isn't the main point. Direction and persistence are. 5 consecutive deficit years is not a cycle, it's structural. Finally, exchanges. Total inventory numbers can mislead. Some metal is spoken for, in the wrong category, eligible but not offered. The market cares about registered deliverable metal. That's the moment of truth, where paper meets physical. Registered inventory has fallen sharply from earlier peaks and can drain rapidly in a single heavy demand window. Because in a tight environment, a large withdrawal in a short time doesn't just reduce availability, it changes psychology. It signals that someone needed real metal and took it. Once that signal hits, other buyers don't want to be last at the window. Recently, more than 33 million ounces were reported as being pulled for delivery in roughly a week. That's not a rounding error. It's a warning light. And here's the cliffhanger. If that pace of withdrawals continues into a major delivery month, what happens to the credibility of settlement? Settlement credibility is the foundation of pricing. Spring isn't just a season, it's a set of deadlines. Manufacturers plan production cycles, sign contracts, lock materials, and set delivery schedules. If they cannot secure inputs, output must be revised. That's a business crisis, not a chart event. Spring targets get attention because procurement cycles collide with reality. When reality is tight, contracts get renegotiated at higher costs, or aren't filled at all. That's when panic begins. Consider the bank target everyone mentions. When a major bank points to a spring level around 135, it isn't hype. It's math. The market may need a higher price to balance supply and demand, because price is the lever that reduces demand or encourages supply. But supply can't increase quickly. That leaves price as the tool. Here's the uncomfortable reality. Many critical industrial uses can tolerate higher prices because silver is a small fraction of final product cost. They keep buying, keep paying, and keep pushing. Demand destruction, if it comes, may require much higher prices than most expect. Now add the geopolitical lever. In a concentrated refining hub, tightened licensing, export restrictions, or selective approvals can immediately shrink available supply, even if the rules sound technical. Controlled supply is not a free market. New licensing thresholds that only large, well-capitalized refiners can meet may reduce exporters fast. Fewer exporters mean fewer buyers can secure metal. When buyers scramble, premiums blow out. Policy turns into a price lever. Dependence matters. If a country consumes more silver than it produces, it relies on imports. Imports are contracts, shipping lanes, and relationships, not guarantees. If inventories are draining and refining chains are concentrated, vulnerability rises. Planners respond with supply deals, domestic production incentives, and accelerated permits. But even if executed perfectly, they're late. Consider the buyback math. A government that once sold metal when prices were low now faces triple-digit prices before premiums and delivery fees. Replacing the same ounces costs multiples more, and the act of buying pushes prices higher. Rebuilding even a fraction of past reserves requires tens or hundreds of millions of ounces, but global mine output is just over 1 billion ounces, much already spoken for. A large official buyer competes with solar, EVs, electronics, data centers, and every industrial buyer that cannot pause production. A government stepping in doesn't calm a market, it tightens it. Cliffhanger. If official buyers negotiate long-term supply directly with miners and refiners, what happens to the open market float? It shrinks. Fewer ounces available to absorb shocks, rising volatility. That's why 135 by spring can even be conservative. Price may need to rise sharply to ration marginal demand because critical buyers can tolerate higher costs. Exchanges manage claims, not metal. When claims hit physical limits, rules shift, margins rise, timelines stretch, and the public sees in real time that a promise and a bar are not the same. The question isn't not whether silver can rise, but guess whether the system can stay calm while it does. Watch the demand mix. It's stubborn. Solar panels, EVs, high-performance computing, AI hardware, 5G, grid modernization, advanced medical devices, they all consume silver continuously. In many products, silver is a small part of total cost, so manufacturers keep buying even as prices climb. Demand destruction begins only at much higher prices than casual observers assume. The 73% collapse of strategic reserves is more than a statistic. It's lost optionality. Past buffers are gone. Scarcity under time pressure behaves like a spring. Press on one side, it snaps on the other. Cliffhanger. What if the next big move doesn't start with a headline? What if it starts quietly, with procurement draining the last deliverable inventory, and the headline appears after the market is already repriced? That's how real moves often happen. The public sees the smoke after the fire has spread. Mainstream narratives screaming sell now may be designed to shake weak hands. Fear campaigns exist, but that doesn't mean warnings are wrong. Incentives are at play. Looking ahead, two broad paths emerge. One, the calmer path. Prices rise, premiums stay elevated, and the market clears at higher levels while supply slowly responds. Two, the messy path. Inventories drain faster, delivery stress spikes, and the market experiences sharp moves as participants scramble and exchanges tighten rules. Confidence determines the path, and it can crack quickly if physical availability tightens. Spring is a calendar of stress points. Procurement and delivery windows demand vigilance. Price levels, 92 is a signal, not the end. 135 is a stress marker. In disorderly scenarios, overshoots happen, and the market may not return to the old world. If supply is structurally constrained, baselines change, floors move. The takeaway? Silver is scarce in the ways that matter. Deliverable, scalable, under time pressure. Scarcity under pressure produces violent repricing. Don't get distracted by daily noise. Watch buffers, flows, and the behavior of real buyers. Observe premiums, delivery times, allocation language, and inventory categories. Panic is triggered by action, not headlines.